Good morning, everyone, and welcome. This is Joe Scarice, co-founder and co-host of the Creative Birth Strategy podcast and house here on Clubhouse and live on Spotify, Amazon, Apple, YouTube, Facebook, etc. So we'll get started here in just a few minutes. Be sharing this out, get things rolling, and we'll get some information out there. Give me 1 minute. My thumbs are not working as quick as I want to today, and we're getting things going right away. I have to say, we're celebrating close to our 60th downloaded podcast nationally. It's going really well. I have to thank a lot of our sponsors, of course. Love to thank Mr. Yordell Perkins, our social media architect, as I call him, our Oz behind the drape with Perkatech. He is our social media strategist. He provides social media strategy for real estate professionals nationwide. I'd like to thank Miss Linda Pelagas with Realty 411 in regards to her national publication and her national events that she's provided and collaborated with the Creative Birth Strategy podcast over the last several years. I'd like to thank also MB Capital, my referral partner that provides unsecured business lines of credit for real estate investors nationwide and helping them expand their market and really their stretch into the investment space. And last but not least, I'd like to thank Lenmar Capital with which is our nationwide asset-based lender. My name is Joe Scarice. I'm the senior loan analyst, and we provide asset-based lending for real estate investors in all 50 states. We really focus in that 1 through 4, 5 through 25, multifamily or single family through 4 family space. We provide also um, uh, fixed to rent, fixed to flip, new construction, mixed use, as well as blanket loan scenarios throughout the country. We provide advisory and strategy for our real estate investors. So we'll get started here like in the next minute or two here. We're going to dive into empowering real estate understanding of DSCR and cap rate. And I think it's kind of a weird dynamic, but before we get into there, let's update the market. As we know, this past week was extremely tumultuous with job reports, unemployment reports, inflationary numbers. We had a cap bounce on Monday. I kind of feel like it was a warning shot to things that could potentially come very soon to us in the market. Like I said, the rates are very tumultuous. They leveled off at around 6.59 base rate. The commercial rate stood still because they want to watch this to the end of the month. They definitely want to see what Fed Chair Powell says at Jackson Hole, as well as what goes on into September. I don't think anything major is going to be any announcements or resetting prior to that. Very interesting dynamics between the presidential election, where both candidates were talking about either having a little more say with the Fed or a little less say with the Fed. It'll be interesting where that dynamic goes as well. Credit availability, kind of still in flux, but still out there and available. New construction has become slower than renovation. Renovation picked up a little more than new construction right now. So we'll see where that goes into the fall. And I really don't think with this even if there was a major shift in the rate by a quarter point, I don't think it's going to make that much impact for home buying. I think it's going to make much more of an impact in the investment space and bring more investors off the sidelines and cash in out their chips to scale up and acquire more properties. So I think this is more of an investor play in the fall if we have 2 more rate cuts. Because let's think about this. A home buyer is not buying a home in late October or November. It's not that type of market. They typically are traditionally buy in the spring market. So it'll be very interesting, or summer market for that matter. So I really don't see home buying picking up when you still have a very inflated real estate stock of inventory and a very stagnant market where the days on the market are just sitting, prices are not dropping. There's a little bit of stubbornness to the market right now. And why? And then unless you have to sell your property, the individuals that took advantage of 2% money back during COVID, they're not going anywhere. So that they're not gonna suddenly get up and go and say, hey, I'm gonna sell my property to pay 7% for my money. It doesn't make a lot of sense. There's still a lot of free clear money out there as well, so it'll be interesting to see if they start leveraging that money to buy or obtain more property for themselves. But again, very interesting market to watch. Um, and we'll dive into this right now by tying in understanding DSCR and cap rate. And I put an article about this out. We do post two articles that line up with the subject at hand every week on my LinkedIn, Facebook, Instagram, Alignable, Threads, Twitter. It's all out there. So please take a review of this when the time comes. So cap rate and debt service coverage ratio are two essential metrics used in a real estate investment and financing. Understanding the differences and applications of each can help you inform decisions about property investments. I'm going to break it down, and then I'm going to give a little insight. Then we're going to open it up to our moderators, of course. So we'll get started here in just a second. So cap rate is the ratio of property net operating income, NOI, to its purchase price or current market value. It's expressed as a percentage and used to evaluate the potential return on investment for a property. Debt service coverage, though, is the ratio of property's net operating income to the annual debt service total mortgage payments, including principal and interest, and it measures a property's ability to cover its debt obligations. Key differences between cap rate and debt service. The purpose: cap rate focuses on return on investment independent of financing. Debt service coverage ratio focuses on the ability to cover debt payments considering financing. Calculation-based differences. Cap rate based on a property's market value or purchase price. Debt service coverage ratio based on the property's debt obligation. Risk indicator differences. Cap rate helps evaluate the investment risk and return profile. Debt service assesses the risk of defaulting on debt obligations. When to use each. Cap rate ideal for comparing potential investments when considering purchasing properties outright or when assessing the market value. DSCR, crucial when financing a property, ensuring it will generate enough income to meet debt obligations. Understanding both metrics allow investors to make well-rounded decisions, balancing potential returns with the risk associated with financing and market conditions. And I'd like to give you my thoughts to DSCR and cap rate. As a lender, I feel there's a misuse of cap rate in the residential investment space. They really don't know what they're really referencing to. Oh, I have a single family or two family house with a cap rate of 12%. Guys, we don't use cap rate in the two family arena. Now, if you added a zero to that property and the loan amount was above $1 million, of course we're going to use a cap rate on the buy side. But we're still going to evaluate the DSCR of the property. Real estate agents have taken and stretched terms to satisfy the shiny objects for investors by using fancy words. At the end of the day, cap rates really should be left for the multifamily, office, retail, commercial environment. And I think, DSCR should stay in that 1 through 4 space and loan amounts below $1 million. And that's me as a lender, and that's my personal opinion. You know what opinions are like, but I feel like there's a misuse of that subject matter. And I think people don't really understand what they're saying when they use the cap rate for investors on a smaller balanced loan or property or asset. I think, there's things that you need to keep in mind on both is what is the cash on cash return, whether it's the cap rate number or the DSCR number, because again, that could be construed. What's the internal rate of return, the IRR? What's the cash flow? And again, the term gross rent multiplier comes up. The GRM helps investors compare buildings and roughly determines a building's worth. Okay, good GRM will depend on the local market and comparable properties. What the LTV ratio is. Understanding the difference of rate and DSCR cap rate based on leverage and LTV or loan to value, I think is more of a measure amount of leverage on a particular asset. And what matters to a buyer, how they buy and how the deal looks like. And why does LTV matter? Because of rate. It impacts DSCR, it impacts cap rate. Operating expense ratio. A lot of people don't take operating expenses in when they're figuring out their debt service. They usually leverage that a little more on their cap rate, but I don't see people tying in their operating expenses enough in understanding their DSCR. And I see some issues there when it comes time for terms being issued after post underwriting. And then occupancy rates. What is the physical vacancy rate? What's the economic vacancy rate? And why does vacancy rate matter? Listen, as an asset-based lender, if you don't have a lease in place and somebody's not renting the property, how do I asset-base the loan? Real estate investing metrics guide investors when deciding to buy or sell potential properties. They also help track performance to identify problems before they damage your business. Each ratio tells a different story about your business or your property. Thus, consider them in the context of the market, the building, and your investment goals when using them to inform your plans. Good morning, Amy. Welcome. Brief overview, who you are, what you do, and thoughts to our discussion this morning. Empower your real estate understanding DSCR and cap rate.
Morning, Joe. I'm Amy Palvido. I'm the founder and CEO of a real estate technology company called Facilimax. I am also the chair of the U.S. PropTech Council. PropTech is real estate technology. The U.S. PropTech Council is the trade association for the real estate technology industry in the United States. I'm also a longtime real estate investor. I've been real estate investing since 2008. And prior to that, I was a general contractor. So I've been in commercial real estate for over 21 years. And all I'm going to say, Joe, is amen, amen, amen. I am so sick of people misusing cap rate. It's so annoying. And honestly, it's very misleading to a new investor. So I'm so happy that you're talking about the subject. But yes, I mean, cap rate is extremely crucial, and understanding cap rate as far as how it relates to commercial real estate, which is where it should stay, is super crucial. And it affects a lot of different things. You just got to understand it's a quick and dirty way to value a property. So you apply a cap rate, which goes up and down depending on the market. And usually if you want to know what the cap rate for your particular property is, you ask a broker. They can tell you. Because they're in the market every day. They know where it's kind of sitting. And you take your NOI and you divide it by your cap rate, and that should give you a pretty good valuation of where your property sits. But cap rates go up and down lots of times. And right now, cap rates have expanded because values are lower because we're in a real estate recession. So, but don't use a cap rate on a single family home. That doesn't make sense at all. And because they're valued completely differently. You don't value a single family home based off of its NOI. That's not where the value is derived. So yeah. But a DSCR is also important in commercial real estate. Your lenders won't give you a loan if your DSCR ratio is bad. So you got to know what that is too. I think for every new investor in it, and what I wish the industry would change is adding the reserves into your operating expense or into the DSCR calculation. A lot of people don't do that, but it's hitting your cash flow. And so if you don't include your reserves, a lot of the time as part of your normal operating life, you won't pay them, and then eventually it just causes problems later. Sometimes the mortgage company will be good and they'll do it for you and they'll ask you to pay your tax reserves, but they hardly ever do. Sometimes they'll do your CapEx reserves. But this whole conversation whether the reserves should be included, for me, yes, that's how you run your business. You include them. So those are kind of a couple of my thoughts today. Out on a walk again, so I apologize for the noise. I'm down by the river.
It's all good.
Nice day.
So Amy, couple of quick things. If anybody does not know, Amy has this great council now called PropTech Council. Is there anything coming up that we need to be aware of or keep a heads up, and where should we find you on LinkedIn and all that? Can you put the link into the chat box and all that stuff?
Oh, for sure. The PropTech Council is having a very large event in New York City. There's New York City Real Estate Tech Week. So we are partnering with MetaProp, which is a large real estate technology venture fund, and CRETech, which is one of the largest real estate technology conferences. And we're hosting events with those two entities, and it's called New York City Real Estate Tech Week. So that is in the middle of November. and I'll be in New York for a whole week, and then the other major event we'll be at is called Blueprint, which is in Las Vegas in the middle of September. So those are our two next up and coming events. And I'll put the information in the chat. But if you're interested in real estate and how it's going to be innovating in the near future, those are the two events you should go to for sure.
So, Amy, one last question before we keep moving forward. Why do you think there's such a poor usage of the terms cap rate versus DSCR in the space for investors? Is it just the shiny object idea to use fancy words? What's your thought?
It's, as far as why they're misappropriating the term?
Yeah. Why do you think that's the case?
Oh, I just think look, I don't knock anybody who's trying to hustle. And I think realtors who are trying to hustle and drum up business, more power to them. But you just want to do it in an educated manner, right? Because you don't want to. And look, back in the day when I first started real estate investing, I made a bunch of stupid mistakes and said a lot of stupid things that I should have never said because I was learning. So I just think it's more on an educational piece than anything. Why they're saying the wrong thing, for sure.
Thank you, Amy. I appreciate your time today. So, interplaying between DSCR and cap rate, understanding the interplay between those two, is pivotal in the realm of the real estate investment and finance. These two metrics, while distinct in their focus, are intricately linked, influencing the decision-making of investors and lenders alike. I'm always looking at the DSCR. I'm always looking at the operating expenses. I want to understand what the cap rate is if the property loan amount is above $1 million. Okay, so there's a lot of things that I need to look at when I'm evaluating my numbers on the subject property. I'm having deeper discussions with clients. So DSCR measures the cash flow available to pay current debt obligations and reflecting the financial health of the property in terms of the ability to cover debt servicing. Cap rate, on the other hand, is a valuation measure that indicates the rate of return on the real estate investment property. The rate is derived from the net income, which is the property expected to generate, and is used to estimate the investor's return on investment. So, like as a lender, my perspective is a higher DSCR indicates a lower risk of default, as it shows that the property generates a sufficient income to cover its debts and expenses. The impact of DSCR on cap rate, a property with a high debt service may command a lower cap rate, as it is seen as a safer investment. Cap rate influence on DSCR, conversely, prevailing cap rates in the market can affect the perceived risk of property, thus influencing the DSCR. And then there's always market conditions to keep in mind and inflationary issues to take into consideration. Justin, good morning and welcome. Brief overview who you are, what you do, and thoughts to our discussion this morning. Empower Real Estate Understanding, DSCR, and cap rate.
Yeah, good morning, everybody. I'm Justin Jefferson. I'm an investor in Southern license, and property myself. Well, I think we had a bunch of different. Amy shared a few perspectives on that. I think kind of lean into the two topics you guys have already mentioned on DSCR. DSCR and the cap rates. And I do believe cap rate has become over the past 6-7 years has become this thing's been put on the list of terms to sell and try to draw attention to investors. Now, what I found having these actually having these conversations with people, once let's say I deliver to one of my investors a property, and on that advertisement on that flyer or my presentation, right, depending on the level of the sophistication of the deal, I might have that cap rate that was provided by the listing people, right? Also, a lot of times you're going to want to know how to calculate your own capitalization rate. There are a number of factors that go to a capitalization rate, which make it make it a rate that can vary, right? Just depending on the perspective and what somebody plans to do with it, what terms they're able to get on their financing, and different things I believe can, uh, affect what somebody's actual capitalization rate is going to be. It is an assumptive, it's something that you're putting on an assumption. However, it's assuming these things go right. This is the rate at which XYZ should happen, right? You should capitalize, right? You should get back to basis. So I absolutely agree. I do, however, believe that if you're in sales or if you're in whatever um, kind of field you're in as a professional, real estate professional, and you're using capitalization rate to describe something, you absolutely need to know what you're talking about. I mean, you can't give anybody a pass for trying to do, or because they feel like this is the right thing. This is a serious business, and there are serious consequences for missing this number by decimal points. And we can put numbers on how much money can be gained or lost or misrepresented, right? By misrepresenting the capitalization rate, somebody going put their own money into a deal based on, obviously there are going to be more factors than that, but let's say there's somebody, and they're basing it on what they believe the capitalization rate is, right? So my point is understanding it in full, understanding multiple angles, right? To look at a deal, to check it across the your standards that you have that are going to get you to your end goal, and making sure all those things align. Capitalization rate is one of those many things that you need to tune into. And I'll keep it brief because I've been talking a little bit, but the debt service cover, the DSCR, I believe is something we use more often and more commonly across properties. I believe how much it just real simple concept, right? What is the debt on this property? How much is it generating, or what do I have incoming to service this debt? And what is the ratio between the two? And that ratio can give me a much better indicator for me at a quick glance as to how the property is performing financially. So that's just my quick thoughts on the two, how they play, and where I could kind of utilize them and look out for.
Thanks, Justin. Appreciate the insight and detail. Um, there's some things that we want to keep an eye out. There's some really competitive markets out there that we need to. These are the markets where you got to keep in mind when it comes to debt service coverage ratio and cap rate. And you really need to keep an eye on these markets because they impact the rest of the country. So I'm going to go real quick, the hottest markets that you got to keep an eye out, and then the smaller markets that you might want to kind of see. And Ed, please mic your phone. Thank you. So number one is Miami, Florida. You got to keep an eye on that market. Milwaukee, Wisconsin is number two. North Jersey, just a whole demographic. Jersey City is becoming the fastest populated city in the country right now. You got to keep an eye on there. There's another area down in South Jersey in the Monmouth County area, Long Branch and Asbury Park. That whole corridor there, you need to keep an eye on that area as well. Suburban Chicago, a lot of people are getting out of Chicago because of crime and safety and the illegal immigration that's coming into the city. Grand Rapids, Michigan is another market you want to keep an eye out. Oklahoma City, Oklahoma. Bridgeport, New Haven, Connecticut is a very hot market. It's more of a Section 8 play, affordable housing. It's got a train stop. It's got a lot of things going for it. Still has a long road to come down the road. It's not a very landlord-friendly environment, but again, it's an area to keep an eye out. Cincinnati, Ohio is staying very, very strong. Lansing, Ann Arbor, Michigan, Orlando, Florida, Orange County, California, Brooklyn, New York, Omaha, Nebraska, Southwest Florida, Eastern Virginia, Kansas City, Kansas, Tampa, Florida, San Diego, California, the suburban area of Philadelphia, the counties surrounding Philly, not Philly proper. Even though the rental market is moving in a favorable way in Philadelphia proper, it's still the rental appeal is outside the surrounding areas. Silicon Valley, California. Some of these hotter, smaller rental markets, you want to keep an eye out for DSCR cap rate influences. Fayetteville, Arkansas, Lafayette, Indiana, Lehigh Valley, Pennsylvania, that Easton, Bethlehem, Allentown market, even Schuylkill County and the surrounding area of Northeast Pennsylvania. That Wilkes-Barre Scranton area is getting very strong as they lay tracks down into the New York City corridor for train systems. Harrisburg, Pennsylvania, that surrounding area, very strong. I love Madison, Wisconsin. It's a sleeper market. I like it a lot. Little Rock, Arkansas, I like that market as well. Another sleeper market. You got to be concerned a little bit with crime stats, but a very good market. Providence, Rhode Island, a lot of migration coming out of Massachusetts, pouring into Rhode Island, pouring into New Hampshire, Vermont, and Maine. Worcester, Springfield, Massachusetts, and then topping off the 10 is Tulsa, Oklahoma, which I like a lot. I've been there a couple times. I see a lot of conversions, a lot of cap rate discussions on multifamily, mixed use, and a lot of good single family through four family debt service coverage ratio numbers. Good morning, Mr. Martella. Joseph Martella, brief overview, who you are, what you do, and thoughts to understanding DSCR and cap rate. And I know you're going to touch on cash that ties into both of these as well.
Oh, geez, you know me way too long. I have to stop talking to you. So, good morning, Joe. I know it's been a minute. So, yeah, listen. I mean, you always make fun of me, and I'll admit it. Right, the DSCR, and we went over a loan for me, and you say, "Oh, it's 1.53." Well, that really means nothing to me, right? It means something to the bank, and what their loan purposes are. But as an investor, it means nothing to me. And then you talk about cap rating, a lot of these fancy terms. And it's really interesting because I was looking at a multifamily several months ago, and another investor was like, "Oh, well, you can't evaluate it the way you evaluate a single family home. You have to go based on the IRR and the cap rate." Everybody knows these fancy terms. And that investor didn't own any multifamily. Really, the numbers go down to, right, do the numbers work? Are you going to be making enough cash flow to support the maintenance on the property as well as cut yourself a profit every month? And that's where it comes down to, right? I like cash on cash return. Joe mentioned it, right? I'm looking at, if I'm taking money down and I'm putting it into this property, am I making, number one, enough money to support the maintenance on this property as well as bring the profit back? And am I putting enough money down to where I'm making money on the cash out of pocket? If I'm making 8% and I can get 5 point something percent in a CD in the bank that's secured, I'm really only making an investment for 3%. Do you really want to risk your money for 3%? We can make the argument about appreciation and depreciation and tenants paying down the mortgage and you getting that. We can make that argument all day, every day. And take the opinion. But if I'm only risking my money for 3%, then it's no deal for me, right? This is talking about a Joe Martella rule for Joe Martella. I like 15 to 20% cash on cash return, right? And if Joe says it's a 1.25 DSCR loan or 1.5, so be it. But I don't care. I look at it, what am I putting in? How much am I getting back? And is that investment going to be able to support itself? Is it going to be a good addition to my portfolio? That's how I look at it.
So two quick points. Are you looking at the return on the money within a certain amount of years? Is there a certain ratio of number of years that you want to recover your down and money into the deal? And two, are you focusing in that single family through four family? Are you looking at the vacancy considerations, and what are you also looking at what type of reserves, like Amy brought up, that you might want to keep around for per property? Like, what are you thinking as an investor?
So all of the above, yeah. So when it comes to reserves, I have a number in my head. As my portfolio grows, that number grows, that I keep in a savings account. I'll take that money, I'll put it in short-term T-bills, so I'm growing it at least at 5%. That if I need a couple of roofs in my 7 units, my 7 houses that I own, if something goes disastrously wrong where I need access to, 10 or 20 grand, I have access to that, or 30 grand. I have access to that. So I'm not stressed out about that. The market for single families and is really good right now, at least, or it's getting better, I should say. Starting to see days on the market sitting. I'm starting to see, you know, I just rented a single family house that just came available unexpectedly with 2 days notice. And I wound up getting about a $900 a month increase, and I had it rented within a week.
Wow.
So the rental market is strong. So I'm watching my rental vacancies, and I'm keeping eyes on that. Did I cover everything? There's something I missed, Joe?
No, you covered it perfectly. Thank you, Joe, and great to see you back, and appreciate your time here this morning.
Thanks.
Thank you. And rumor has it we might be hanging out together as friends today. So yeah, there is a deep dark rumor, but again, it's just a rumor. That's all we're going to say. So thank you, Joe. Good morning, Travis. Welcome. Thank you for coming up. And now this is the real Travis Foote. I get to see the real face of Travis. What's your thoughts on DSCR and cap rate? You know, in your Texas market, I mean, that's everything, right? I mean, like everybody's throwing those terms around. Like, what's your thoughts of this as a property manager, owner, investor, realtor? Like, what's going through your head with this?
Yeah, well, the first thing that comes to my mind is, cap rate and DSCR are not intermingled, right? They're completely separate things, which probably somebody's already talked about that. But one thing about cap rate that I know that I learned a long time ago is it's very close to, it's tied to the interest rates, right? As interest rates rise, cap rates rise. As interest rates go down, cap rates go down. And I think at first you would think, okay, a cap rate going up is a good thing, but it's not. It's actually inversely, it inversely affects the value of the property, right? As a cap rate increases, the value of the property goes down. And it makes a lot of sense that it's tied to the interest rate because, if I can put money in the bank and I get 5% interest and it's guaranteed by the Fed and all this other stuff, why would I want to invest that money in a riskier asset and get like the same interest rate? If the return is 5% in the bank, then the cap rate for a property, has to be at least 5% or better. And if it's 5%, it must be an A-class property, right? So I think that's one of the things that that people need to know. I remember I was at an investing thing, a little seminar thing over a weekend a couple of years ago, and these guys are trying to sell people on syndicating and investing in their syndication. And, at the time the rates were starting to go up and they were talking about, oh yeah, when we get this apartment building done, we're going to sell it at a 5 cap rate. And they're saying, well, right now the cap rates are 6 or something like that. And I'm talking to the friend I was with and I said, listen, don't listen to those guys because as the interest rates go up, that cap rate's going to go up. They're not going to sell it for more than they think. It's going to be less than they think. So it's something that people need to be aware of. As far as DSCR, if you're buying properties cash, then you don't have to worry about that, right? But if you're buying a property with a loan, yeah, you need to know, is the property that I'm buying, is it going to be able to cover the debt, which everybody's talked about, and is it going to bring me any money? And right now in my market in the Houston area, it's really hard to find something that's going to cover that mortgage payment at the current pricing. So, I don't know where the guy that was just speaking, where his market is, but I can tell you here in the Houston market, it's tough. And, for the best DSCR coverage ratios, usually it's like in the worst neighborhoods.
Travis, you brought up some points that I'm thinking about just as hearing you. I think these syndicators or self-proclaimed syndicators or whatever you want to call them, partnership groups, they are chasing money right now because there's a very limited inventory for them to make money on with rates being so much higher. And most of them don't have economical cycle experience past the current past 10 years to compare against. I think there's the problem I see here is you can see a lot of younger people, they don't have money, they want to raise money, but they have no economical cycle experience past the past 5 to 10 years to compare against. None of them understand what happened in 2008. None of them know what happened or even was remotely born yet in 1992 with the unemployment issues, or witnessing gas issues in the late 70s, or economic conditions and restructuring of a lot of major companies out there in the 80s, and rates still at 12% as early in the early 80s. None of that's in economic history books for them to kind of draw comparatives to. And I think that's what scares me. I saw somebody today or yesterday post, "Hey, I'm going to start an underwriting class, and I'm going to charge you to learn how to underwriting." And my question back was to him, I said, "Where have you done underwriting for? What fund? Like, who have you worked for in the last several years underwriting files for clients?" "Oh, I haven't. I'm only underwriting my own." Oh, so you're favorably underwriting your own deals, but you haven't underwritten anybody's independently. No. So what gives you the right to teach anybody a course? Like, I think again, it goes back to the Ponzi environment. Hey, if I can grab some money in the interim to claim I can do this, or I'm using some fancy terms without the financial literacy for the people that are attending. But like when the light bulb goes off with somebody like yourself that has 30 years experience in the business, it doesn't make sense. DSCR, you could be at 1.0 and make really good cash flow and have all your money out in 2 years. That might make a lot of sense. Cap rates could still work at 7 or 8% if you buy correctly, and your numbers all work in line. I mean, it could be a little more deferred maintenance type of property or asset, but it still can work. So I think there's a misconstruing of who your professionals are in evaluating deals. And I think the whole industry is in a big pie has watered down. It's a shameful thing, but it is what it is. Amy, your thoughts to that before we go to Linda?
Yeah, so I was a syndicator for a very long time. I started syndicating back in 2010. And when the newer syndicators would come on, yeah, that's exactly what happened. But to your point of understanding cap rate and what this means, when you have a newer syndicator who's never seen a real estate cycle, right? They basically, let's just be realistic. They're complete knuckleheads and they don't know what they're doing. So even if they had an asset that they went full cycle on, so say they bought it in 2018, they sold it in 2021, they could have completely done everything wrong on that property and still made money because the cap rates were compressing. So when you understand that when you say you take your NOI and if you improve it by $1 and you divide it by that cap rate, and say the cap rate at the time was 5%, you basically added $20 of value to that property. It's now worth $20 more by just increasing the NOI by $1. That's what cap rates do. So same thing. They totally screwed everything up, but the cap rates dropped. So they got to participate in the cap rate compression, making their value so much more, even though they didn't do anything to earn it. Yeah. So that's commercial real estate. That's what happened. So for investors who are looking at these syndicators who've only been doing this for like 3 or 4 years, I would not invest with them. They still don't know what they're doing. And I would just truly understand that in this real estate cycle, you need to pick somebody who's been doing it like good 20 years, for sure.
Thank you, Amy. And, I'll give you a great example. I'm working with a client right now. He's focusing on 25-unit motel conversions. He's taking a motel. He's buying at $50,000 a door, no more, no less, maybe a little more, a little less, depending on the size of the motel units. And he's putting approximately 30 grand into each door for upgrades to convert them to Section 8. And he knows his back end value is no less than 110 based on the cash-on-cash return, the DSCR of the loan, the DSCR of the debt stack, as well as the cap rate on the back end. He's evaluating all three at the same time. He's all in and out under 65% loan to value on these conversions. Okay, he's using all three metrics to come up and derive his number. And then guess what? He's using me as advisory. He has a couple other individuals in his advisory group, and everything's coming out correct. The cash that he's making on it, that's spinning off, is so tremendous. He doesn't even need to take cash out of the property. It's just spinning off so much money. But he's taking money out just to put in reserves for the what ifs and the deferred ongoing maintenance issues that could come up and derive from doing Section 8 or veteran housing is where he's focusing right now. So to Amy's point, I'd rather be around somebody that's got a couple economic cycles under their belt, that understands these metrics and understands the measure, the potential return on all three investment potentials. I'm seeing too many syndicators coming in and out, and then suddenly now they're instructors, and now they're not doing what they claim to be doing. Because how do you run thin if you're doing value adds on cap rates and syndications if you're not buying correctly? It doesn't. If the rate even went up 200 basis points, you still should be making a ton of money if you bought and understood the deal correctly from the beginning. Somebody did not calculate and underrate the unforeseen and the risk, and that's why we're going to see some foreclosures. We're going to see some assumable loans out there that are going to be great opportunities for some people. And you're seeing that already, and you're going to see a lot more of them over the next 3 years. Linda, good morning and welcome. Brief overview, who you are, what you do, and thoughts to the discussion. Understanding DSCR and cap rate.
Good morning, Joseph. Good morning, investors. My name is Linda Pliagas, and I'm with Realty411.com. We're a news and information website for investors, and we produce magazines, events, webinars, podcasts, all in an effort to help investors on their journey towards real estate success. Now, in regards to today's topic on cap rate, the cap rate is an important concept to know in commercial real estate. The cap rate simply represents the yield of a property over a 1-year time horizon, assuming the property is purchased with cash and not on a loan. The cap rate represents a property's intrinsic and unlevered rate of return. And an example to find out the cap rate, an investor needs to divide the NOI, which stands for the net operating income, with the market value to acquire the cap rate on a property. Now, in regards to syndications, Amy brought up a great point about investing with syndicators that have long-term experience and who have gone through, a cycle or two. It's also important, I feel, to have relationships with the people that you're going to be investing with. And know them and get to know them and their philosophy on investing, their philosophy on life. It's important to get to know people and build relationships with people in the real estate investing arena. One of the best ways to do that is to get to know them in person by attending some of the events that they may produce or they may host. A lot of syndicators have virtual webinars that may be worthwhile to attend. And a lot of the virtual webinars and in-person events really do provide great information and networking opportunities as well. So that's a great way to get to know, more people in this space as well. Thank you so much for this platform, Joseph, and back to you.
Thank you, Linda. Linda, quick update to Realty 411. What do we got happening now, prior, and ahead of us over the next couple of months?
Thank you so much. Yes, we just completed a real estate expo and conference in Southern California, August the 3rd. It was attended by a couple hundred people. We had a great time, wonderful networking. Now, our large Los Angeles Real Estate Grand Expo will be held October 26th. And we do always host between 800 to 1,000 investors from around the country who fly in for the day. And we're really excited about it. So if anybody on Clubhouse would like to network with over 500 investors, learn from 12 to 14 speakers, and also we'll have about 50 exhibitors. So it's a chance to really plump up your database with professionals by getting business cards, networking, and making connections with investors from not only California but from around the country. Thank you.
Thanks, Linda. Linda's been a great ally of mine with the Realty 4-in-1. I think we just got a promo that went out in regards to my company, myself, and my bio. It looks really fantastic. So thank you again. And balancing cap rate with debt service is an intricate dance of real estate investment. Two key financial metrics to take the lead: the capitalization rate or cap rate and the debt service coverage ratio, DSCR. These figures are not just numbers on a spreadsheet. They represent harmony between profitability and risk management. A savvy investor knows that a high cap rate can indicate potentially lucrative investment, but without a solid DSCR, the melody of success may quickly become discordant. Balancing these two akin to finding the perfect rhythm in music where each note complements the other to create a symphony of financial stability. These are very important things to keep in mind as you grow and scale your real estate portfolio as a professional real estate investor, and as well as a professional real estate service, providing services and insight to investors or up and coming investors, or having more detailed strategic discussions with real estate investors. Keith, welcome. Good morning. Welcome. Brief overview who you are, what you do, and thoughts to our discussion this morning, empowering your real estate understanding, DSCR and cap rate.
Good morning, guys. Listening to this conversation today and understanding cap rates and what they do to the single family market, which most people are single family investors. Like I said, like everybody's been saying on stage this morning, doesn't really have like a huge implication. For those of y'all that don't know me, I'm from Atlanta, Georgia. I am a fund manager. I operate in North Carolina, Texas, and Georgia. And just based off of what I'm seeing as far as leveraging debt service, like debt service is one of the products that I do like to leverage. I mean, if you're not buying all cash, obviously you would have to use some sort of debt service. I actually just use the debt service to buy a mobile home in Lewisburg, North Carolina, which just closed on it Thursday. But it's just all about understanding the loan product itself, to be honest, guys. It's really about understanding the loan product and how you can leverage that, having an exit strategy with it. My strategy is a little bit different. I know a lot of people use DSCR loans for just to try to cash flow. I'll be honest, like in today's market, that's not what I'm really looking for. I have a long-term strategy with anything, especially being in the markets like Texas, Georgia, and North Carolina, where there's not a lot of cash flow opportunities today. But, with rates being on a higher, being at a higher, I guess, value or whatever you want to say, we are still, like I said, making money off of the appreciation within the 5 to 10 year time frame. Let's just look at it differently, guys. At least in this market cycle, I'm not so heavy on cash flow. As I said, I really want rates to continue to go up. I know people are like, whoa, why would you even say something like that? Well, it's because I've been getting good deals with rates being higher. And I know how to not lose money when with higher interest rates as well. But yeah, that's a little bit about me, and that's my strategy, and that's how I feel about cap rates. Though, as far as commercial, on the other side, cap rates do. I did take down 22 units in San Antonio this summer. And yes, cap rate was definitely a metric that we use. We got in at a higher cap rate. Our job is to lower the cap rate. We bought at an 11 cap, and we're trying to increase the income to where we can sell it at a 6 cap. That's the goal within the next 5 years. But yeah, guys, that's me.
Well, Keith, thank you for coming up, and that's why I pulled you up. I thought you were asking some good questions in the chat, and I agree with you. I think I like rates at 7%. That's been a national average for the last 40 years in our industry. I think that it weeds out a lot of the weak and uninformed. I think a 7%, 7.5% rate, because if it works at 7, 8%, guess what? When rates come back down, you could do some maneuvering in your operational efficiency and interest rates there where you could capture some more money to put in reserves or recollateralize into other assets. You know, you gotta constantly be balancing cap rate with debt service, and it sounds like Keith has been doing that along with a lot of the other moderators. Is you got to understand market conditions. You need to understand value add opportunities. You have to understand interest rates. It's not always about the lower interest rate. You also have to understand the property type, the location, the operational efficiency, the thresholds for that investment, and obviously the biggest thing: what is the exit strategy? Is it a long-term hold? Are you dumping this in 3 years, 5 years, 10 years? Is it gonna be a family heirloom? Is it generational wealth? You need to understand these to adjust to the market variations. Okay, local economic indicators. Do you know what's going on economically locally to that property, right? Do you understand the market comparables? Do you understand the growth projections? Adjusting for market variations, local economic indicators, property type, tenancy. Is your tenancy changing? Like, example, Philadelphia, overnight during COVID and riots and all kinds of craziness, it turned immediately into a rental market. Home ownership literally has died. It has been shot. It's dead. It's all about the Section 8 comparative to the market rent. What are your growth projections? What's the interest rate environment? You know, everybody was so excited about Monday. It happened for a brief moment. It was a cat bounce. You got to understand your market comparables. Successful cap rate and debt service coverage ratios in the realm of real estate investment. Cap rate and DSCR are two pivotal metrics the investors closely scrutinize to assess the viability and profitability of a property. While cap rate offers a snapshot of potential return, on investment, DSCR measures the cash flow available to pay your current debt obligations. The interplay between the two metrics are significantly influential in the investment decisions and strategies. Through various studies, we can glean on successful strategies that have allowed investors to optimize both cap rate and debt service, thereby enhancing the overall value of performance of the real estate portfolio. Let's get some final thoughts. We'll start with obviously the rose amongst the thorns. Amy, your final thoughts to our discussion, DSCR versus cap rate.
It's been a great discussion. And you know, I've been a long time real estate investor, and so understanding these two metrics are key to your real estate success. And if you don't understand them, you can get yourself into a world of hurt. But I guess the parting thought would be that you need to, even post acquisition, you need to be constantly looking at these metrics to understand how you're performing your asset or how your asset's performing. Like how are you operating this deal to make sure that, you know, you are generating an NOI buck that you could take advantage of, or is your DSCR dropping because your operating expenses are increasing out of control, and you need to plan what's happening in advance, right? So don't just pay attention to these metrics when you are trying to get the loan and get the deal. Pay attention throughout the life cycle of the investment, because that'll help you make better decisions. So that would be my half a nickel.
Half a nickel. There it is. There it is. Winner, winner, chicken dinner. Justin, your final thoughts to debt service versus cap rate.
Yeah. My thoughts are that if stuff is getting unfamiliar, I would take some time to go educate myself on these things and talk to some professionals, maybe some lenders, whatever lenders are that you, and also take some time on the web up on something, and go take pen and pad and make some attempts at underwriting some debt service, calculators, cap rates. That's just really interested in understanding that. But those are my thoughts this morning, Joe. Great discussion.
Thanks, Justin. Travis, your final thoughts to debt service versus cap rate. Travis going once. Travis going twice. We'll come back to Travis. Joseph, your final thoughts to debt service versus cap rate.
Hey, so just exactly what Amy said was really important. You have to constantly monitor your investment even after you make the purchase, right? You always have to monitor the market and know what's going on around you. And cash flow is absolutely important to me, right? If you're only cash flowing $100 a door and something goes drastically wrong, and you have a $1,200 or more repair, that kills your investment for the year. So you definitely need to pay attention to that. But at the end of the day, you're responsible for your actions, right? There's lots of fancy terms out there that you need to know or be familiar with, but I wouldn't hang on every letter of those fancy terms. You need to do the numbers, and the numbers don't lie, right? And make sure that you're comfortable with what your decision is, and be disciplined to what your needs are, and you're responsible for your actions.
Thanks, Joseph. Linda, your final thoughts to debt service ratio versus cap rate.
Yes, fantastic discussion. Great people in the room with long-term experience. So applaud them for that. My thoughts, always double check the numbers when you generate your formulas, such as the cap rate. I've purchased a lot of properties where the numbers were greatly different, especially in terms of utilities, taxes, management. Always double check the numbers. Thank you.
Thank you, Linda. Keith, some final thought to debt service ratio versus cap rate, and then I'll give my future of cap rate and debt service.
Well, basically what I'll just say for everybody is understand that when you, I guess, create a buy box that works for you. Like everybody has a different situation. If you're coming in as an investor by yourself, obviously, your numbers are going to be different than my numbers, or your numbers may be different than Joseph's numbers. You got to figure out what system works for you, because technically, if you think about this stuff, guys, there's no right or wrong strategy. If you really want to get down into it, you could literally hold on to it for 5 years, hold on to it for 10 years, and that's the same with commercial and residential real estate. Obviously, certain markets aren't the same, but the reality is you want to come up with a strategy that works for you. Look at your financial plan, or look at your financial situation and make a financial plan. That's how you have to, leveraging debt service, leveraging hard money, whichever sort of loan product that you're using, you have to make sure that it's based off of your financial situation. The same thing as far as underwriting the deals that you are trying to do. Make sure that the numbers work for you, YOU, or your partners. That's all I have to say. Good conversation today, though.
Thank you, Keith. As we look toward the future of real estate and the future of cap rate and DSCR investment decisions, significance of cap rate and DSCR remains undiminished. These metrics are not just numbers, they are reflections of the economic landscape, investor sentiment, and the intricate value of properties. They serve as compasses guiding investors through the tumultuous seas of the market, offering insights that go beyond the superficial layers of profitability. In a world where market dynamics are increasingly complex, the interplay between cap rate and debt service coverage ratio will continue to be a focal point for savvy investors seeking to balance with reward. This is an opinion of ours. There's advisory. There's not advice. We are specialists in our field. If you feel compelled to have a discussion with any one of us, reach out to us to have that one-on-one strategy discussion. That's what this podcast, this room was created for. A safe place to have strategy discussions to build out opportunities working with one another. I want to thank our sponsors, Mr. Yordell Perkins of Perkatech, our social media strategist. I'd like to thank MB Capital, your unsecured business line of credit referral program. Realty 4-in-1 with Linda Pelagas, national publication for real estate investors and services, as well as national events throughout the country. And I'd like to thank Lenmark Capital, where I'm a senior loan analyst providing asset-based lending nationwide for real estate investors. And my quote today: never blame someone else for the road you're on. That's your own asphalt. Everybody have a blessed Sunday morning. We'll be back here Saturday morning next week, 8 a.m., Sunday morning, 9:30 a.m. Eastern Standard Time. This is Joe Scarice, co-founder and co-host of the Creative Birth Strategy House and podcast. I want to thank everybody for a fantastic event. Take care of yourself, and we'll see you next week. I'll be ending the room in the next 30 seconds. Take care.